Hello everyone, welcome to my channel. Now today I will discuss something important to every family looking to own a home. Getting a mortgage in this day and age is an uphill task, especially for the average or lower income household. So I get it. You have saved and now ready to get that house. Before you take the plunge, here are 5 key things to consider even before searching for a house. 1. Do you need a house? Now, do you really need a house now? Have you considered your lifestyle? If you are mobile, for example, a travel nurse, soldier, etc., do you need a mortgage for a residential property? I would think not. You may be better served having a mortgage for an investment property, knowing that you have set up a scheme where your tenant is paying down for the mortgage on the home while you are free to rent houses or homes in areas where you are currently living in. It gives you flexibility, and to be sincere, you do not need an empty house just sitting around waiting for you to retire. So consider looking to getting an investment property instead of a residential one. Now, how much house do you need? That's the second thing we need to consider. Do you really need a huge, sprawling complex? Do you really need a house that is 7, 8, 10 times your household income? One mistake people make is buying a house they cannot afford. And I understand when people feel like they're ready to get a house, they want something that fulfills their fantasy. That is something that is a place of rest, but we have to try to fight that urge. You may be better served starting with a small house or apartment and then upgrading in due course as you accumulate equity both by principal repayment and hopefully appreciation in house value in line with inflation and market trends. Your increased equity can then be a significant source of equity contribution to your new home. Remember, this may not be worth it if you can only contribute the same percentage equity in your new house. It's just walking backwards. We're not here to hustle backwards. And what do I mean? If you contributed 10% equity on your first house, should you upgrade, you need to be able to contribute 20% equity in your new house. And if you upgrade again, you should be able to contribute 30% equity in your new house. In other words, you should be getting closer and closer to 100% ownership. If you are still only able to contribute 10% on your second or third upgrade, note that you cannot afford that house. Now, the third thing is location. Yeah, this impacts the cost of the house significantly, just as much as the size of the house, if not more. Now, the easiest response to this is to live outside the city center, but you have to consider commute to your place or places of work and how that adds to the lower mortgage payment. You also need to consider proximity to other important social services like schools, quality utilities, etc. Now, I must say that to reap the benefit of property as an investment, you will be better served purchasing a house outside major cities, as these appreciate more as the main city grows and encroaches or spills over onto its outskirts. They appreciate faster than properties within the city. So aim for properties in up-and-coming neighborhoods, development areas, top school districts, etc. Now, the fourth thing to consider is ancillary costs. To buy a house, there are other costs involved, and you should consider these as you make your decision. These costs include, but are not limited to, survey fees, legal fees, property taxes, stamp duties, insurance, etc. The major thing to note, though, is that some of these fees are a percentage of your house value. So the higher the house cost, the higher the fees. The fact I would want to highlight also is that some of these percentages increase once the house value crosses a certain threshold. Now, if you are middle to lower income, consider keeping your house value below these set thresholds, as it really makes no sense spending more than absolutely necessary on ancillary costs. Note that the one-off costs would add to the total amount you need to have saved up in addition to your down payment. Some of these costs are paid monthly and would add to your monthly repayment, so consider these as well in determining affordability. Now, the final thing to discuss is the plan to pay off. Visualize yourself having got the house. You need to draw up a plan to pay it off. Most banks would fix the interest rates for 2 to 5 years and then recalculate your repayment schedule in line with current rates. However, aligning with the repayment schedule means paying the maximum interest expense accruing on your loan. And this is money that could have been applied better. So then, how do you avoid this? Set up a plan that sees you put down an amount against your principal monthly. Know that any amount paid against the principal reduces the total interest expense you would have paid on the loan. The amortization schedule results in earlier payments consisting more of interest expense, while later payments consist mainly of capital. The more principal you owe, the higher the interest payments you owe, and the only way to combat this is to reduce your principal outstanding. You cannot do this only by relying on your payment schedule. You have to go beyond the expected monthly payment and pay down capital so that your overall loan is paid off sooner than planned and with lower interest payments. Now, this will require strict budgeting, which we can discuss in a different video, but it also requires discipline in adhering to the budget. You will be better served clearing your monthly outlays of other debt payments before you can go for a house. For example, it will be better if you don't have a car debt, credit card debt, new phone debt, student loans, etc. And if you do have these, pay off those you can. And for the rest, consider these when deciding the kind of house you can apply for. In summary, please evaluate mortgages as you would any other thing you need to buy and ask yourself this question: how do I end up not overpaying for this item? It is easy to miss this because the interest element of a mortgage is a blind spot for us at time T. When you get your repayment schedule, do this. Sum up all your monthly repayments over the life of the loan, plus all the fees you paid at start and your down payment. Now subtract the price of the house. The difference represents largely interest expense, and you would need to keep this down by all means possible. Thanks for watching my video, and please like, comment, and share. Till next time, cheers.